Hey everybody, Tom Gentile here. Welcome to my Patterns and Profits podcast. This is for May 10th, Friday, May 10th. This week, I'm going to narrow focus. I want to talk about AI. I've been hearing, we've all been hearing AI. 2024 is the year of AI. We started last year with ChatGPT, but it's really come full force. But are we in a bubble yet? That's the question I want to put to you today. Are we in a bubble? And if so, what's likely to happen? And for that, I go into research mode. In fact, when I research, I use AI now. But I want to research on AI, about AI, and whether or not a bubble is going to occur. And for that, like I said, I have to look at patterns. So what is the pattern that we can look at to start this, to look at booms and busts over the last 100 years? Let's do that. Let's look at the booms and busts over the last 100 years. If there's a pattern, and then we'll talk about AI, and we'll see if that pattern makes sense. And of course, I want to end with the top AI stocks that I'm looking at. Some of them I'm involved in, some of them not, but the top AI stocks that are going to be part of this boom and going to be part of this bust. So I think what we have to start with is the pattern of the Roaring 20s. So if you look at the Roaring 20s, and I'm not talking about the 2020s, I'm talking about the 1920s. Let's go back to the 1920s, the Roaring 20s, the Jazz Age. Most of us, and I'm saying most of us, weren't around during the Roaring 20s. I certainly was not. So I have to go back and look, and I have to, I look at things like the History Channel. You can find YouTube. You can find some great stuff out there of what happened during the Roaring 20s, the Jazz Age, the Great Gatsby was set back in the Roaring 20s, and of course, the 1929 stock market crash that happened at the end. And so, let's talk about what led up to the stock market crash. So, what were the factors that contributed to the Roaring 20s? Well, number one, we had the end of World War I. Okay, now we know, and if you haven't figured this out by now, if you look at patterns of war always bring economic boom. That we've seen that. But go back to World War I. All right, what brings on an economic boom from a war? Well, how about the end of the war? How about the celebration that is finally over? How about the fact that soldiers are returning home and they want to get back to the life they had before war? And all of that brings this sense of hope and relief and expectations of a better life. All right, but that's not the only thing that happened in the 20s. We had technological advancements in the 1920s. And you might think if you're a Gen Xer or you're a millennial, or you're a Gen Z, by the way, Gen Z occupies less than 1% of my audience. But let's say you're part of that less than 1%, and you're listening to this podcast right now. And you're thinking to yourself, what kind of technological advancements did they have in the 20s? The wheel? No, that was long before. No, think about this. Think about if you were living prior to 1900, and then what happened 20 years later. Here's what you saw. The automobile, big thing. And of course, what came along with the automobile? The assembly line. I know that doesn't sound like a big technological advance, but that is huge, and it still is today, to creating and mass producing product. How about the radio? All right, the radio was not an invention before 1900, and we saw the radio come in. Telecommunications industries, the telephone. All right. These things, the washing machine was invented during the Roaring 20s, maybe prior to. I'm trying to refrigeration. That was another big advancement because with refrigeration ushered in this brand new way to store things, to store frozen foods, to make things more. Every technological advancement out there, folks, is to make things more efficient and more convenient to you and I. And so you think about that. You also think about increased productivity. You know, they've connected people like never before. And if you take a look at, let's just talk about the telephone for a moment. So the telephone comes in, the telephone expands. Phones are going in a lot of households. They have to get routed through an operator who then unplugged one A to B to plug it into someone else. And so there was this need for phone operators for the longest time. And then that became automated. And, you know, a phone operator back then had a great job, which then was eliminated. But then came something else. You know, the need to work to handle these technological advances. So those were big, all right? And this was all invented prior to the 20s. And what we also saw was an economic boom. So, I mean, industrial production was up. Here's another one. This one, I don't even know why I didn't mention this before. Electricity. Electricity was prior to the 20s. And all of a sudden, now people who were immediately, you know, they originally scared of this because, you know, what was lighting up homes before electricity? Lanterns. Oh gosh, what am I thinking of here? Oil, and there was, you know, people were heating their homes, you know, with gas, with firewood. They were lighting their homes with lanterns and kerosene. And, you know, at first there was this push to ban electricity because it was supposedly dangerous. But then we found out really quickly that it was not. And that all of a sudden you could flip a light switch on at night to bring brightness into your homes. All right. What else? Urbanization. You saw people, when all this technology was happening, there was this migration from rural areas to the cities because the cities were the first to get these technological advances. And so you got that. You know what else came along with that? When you moved from the farmlands and you moved into the cities for a new life, for you know, to join the workforce, to take advantage of these technological advances. Well, you didn't just walk into a furnished home or apartment or high rise. That was happening too, by the way. You had to furnish this place. You had to put these conveniences in your home. So there was consumerism that was happening. So you had consumer goods. You had the automobile to move you back and forth. You had household appliances. You know, you had, are you going to live in the cities? You know, this is all of a sudden clothing became, I mean, it's a necessity, but now it became more than just a necessity. You know, if you're living in the cities, you got to know what to wear out at night versus during the day. There's entertainment. There's a lot of consumerism going on in the 20s. And then eventually, all of this, you know, you go from the economic boom, you go from urbanization, you go from consumerism, and all of a sudden you get into greed and you get into speculation. And that's what ultimately led to the Great Depression, right? The burst in 1999. And the burst in 1999, there were several factors that led up to that. But let's start with speculation and over speculation. Okay. You know, it got to a point where people were just, you know, they thought, wow, why am I going to work? I can just invest in the stock market because I'm making more money in the stock market than I am in my own job. And that was true leading up to 1929. And so then it was, well, how can I make more money with the money that I have in the stock market? Oh, you know, buying on margin was a big thing back 100 years ago. Yes. Many investors were buying on margin. So, and by the way, margins were not 2-to-1 back then. They were much greater. And so it didn't take a lot for your stock investment, if you were leveraging up 20-to-1, 30-to-1, 50-to-1, to where a small move against you wiped you out. But that wasn't happening so much before 1929 because everything was going up. So there was also, things like the haves and the have-nots. You had distribution of wealth wasn't equal. There was, from the cities to the agricultural areas, big gaps in the economic wealth. There was a banking crisis that was going on, okay, because banks were making risky investments and risky loans at the time. And, the banks ultimately started to fail, which led to that move in 1929. You had the government, which was trying to curb risky investments themselves. That also helped. That really did start the fuse for 1929. Now, let's go forward a little bit. There were other crises, okay? The 50s and the 60s. Here we're coming out of World War II. And they say the 1950s to the 1960s were some of the most prosperous for the middle class, because there was a middle class at that time. But guess what happened in the 60s? I mean, when we went into the 60s, from the 60s to the 70s, that was almost a forgotten era when it came to the stock market, because it pretty much went sideways. Then you had the bubble and the crash in 1987. That's one I do remember. I do remember that. In fact, I got involved in the stock market in 1986. 86, I was 21 years old, investing in the stock market. Crash in 1987. I lost everything. Had to rebuild. There was the real estate crash in 1990. Who can forget that? I know one country that can't, Japan. In some areas, they've never come back since that 1990 real estate crash. You had the dot-com bubble of the year 2000. We're going to focus on that one in a moment. But, you got the real estate bubble that happened as well. That was in 2005, which started to create the crisis of 2008, the financial crisis. And of course, who can forget just 4 years ago? A little more than 4 years ago, we had this little thing called COVID, or back then it was called coronavirus. And then it was changed to COVID. That was a quick crash, though. Quick crash and a V-shaped correction. But I want to talk about the one that most of us here remember, and it was followed by it was a good couple years of a pullback, and that was the dot-com bubble. So let's focus on that, because the dot-com bubble was also tech. It was also tech-oriented. You remember the dot-com bubble? I remember it. It really started in the mid-90s, and Dell Computer was a big player during that tech era. Dell Computer. You had AOL, all right? CompuServe was kind of before AOL. Those of you that are computer nerds out there, what I call retail computer nerds. These are the folks that got a hold of technology that had jobs that were not in the tech industry. So what was CompuServe? CompuServe was the pre-AOL days. I think CompuServe became MindSpring. MindSpring became I don't know what. But anyway, that was in the mid-90s. And then you came into 97, 98, 1999, all of a sudden, there were so many dot-com companies. Everybody was a dot-com. Everybody was a dot-com. And a lot of them went bankrupt. But it was really a lot of just rapid growth, stupid investments in internet-related companies. And it was because everybody was calling themselves a dot-com. And whether you had anything to do with .com, as long as you put .com at the end of your name or somewhere in the prospectus, investors were buying you. You didn't have to have any metrics. You had a crazy valuation. This all peaked in the year 2000. I remember the NASDAQ hitting 5,000 in the year 2000, and there was this big cheering going on, and everybody was dumping money in. Obviously, that was when the bubble burst. We saw just internet companies just unsustainable. That's the best way I can put it. They had inflated stock prices. Their prices plummeted in value. And of course, who loses? The investor loses. Eventually, the company can't sustain business because they basically run out of money. They run out of investors. They cannot IPO more, add to their liquidity. Gone. I mean, it took a few years. It took a few years after the bubble burst before the dot-com companies really started to see declines and layoffs and consolidation and contraction. I mean, you think about it. The real dot-com era was 1997. The peak was in 2000, and the pullback really happened in 2001. Now, what's this got to do with AI? Well, I think AI is going to follow the dot-com bubble. And I believe that more closely on the timeline because we're talking about a narrow focused technology. I'm not talking about, I use the 20s to get you juiced up, to whet your appetite, to whet your beak, so to speak. But when you think about the 20s, yes, there was technology, but there was widespread technology. The dot-com bubble was really narrow focused. It was narrow focused on a computer in everyone's household, the ability to communicate back and forth via computer. I mean, there was no social media back. Well, you know what? That could be arguable. There was chat services. All right, they were the very first one was that I know of was CompuServe used to have this thing called CB Simulator. And that was a way you could talk back and forth to people. Now, most of that was all done private companies. But then eventually, text messaging, remember the beepers? You used to put the number in a beeper and people would use numbers for codes. That was it. And then all of a sudden, alphanumeric pagers came out. And, I was part of a company back in the early 90s that actually brought wireless trading and, more importantly, wireless communication into existence. We used to use it on the American Stock Exchange. And I would be flying into New York, and I could actually, through a Fujitsu computer, be able to text message the office while in the air, as long as I was over a major city. Because back then we had analog signals, not digital. So analog signals could go up miles. And it was quite amazing, something that we had. Anyway, long story short, it was taken over by Bell South and they shelved it. They shelved our packet technology for something that they were doing, which was basically dial-up service, which became broadband service. And looking back, I can see why they did that, because that was much more widely available. This wireless thing was not around at the time, and it was going to take years before that happened. So we were really years, if not decades, ahead of our time. Anyway, back to back to AI and dot-com bubble. There's some factors that AI have that are a lot of what happened to the dot-com bubble. Let's talk about those factors. First, technological advancements. So just like there were advancements in dot-com where we went from private company to company, email, from dial-up to broadband, look at the technological advancements in AI. You got machine learning. You got deep learning. You've got neural language processing, programming, robotics. These are all AI initiatives. Okay, those are the advancements. You also have early adoption. I talk about adoption cycles all the time. And, I do it not only in the stock market, but even cryptocurrency had early adopters. Then it went to institutional. Then it went to mainstream. Okay, all right. And we'll talk about where I think we are in AI as well. But you've got industry adoption with AI. That's where now you got industries coming in looking at how they can use AI to improve their own efficiency, to improve their own productivity and decision making. So you've got that. Okay? Guess what comes after that? Media attention. That's where we start hearing about this on mainstream media. The breakthroughs, the success stories. how companies are applying AI to their own businesses. All right. And after that, you get investor frenzy. Okay. That starts with companies. That starts with IPOs. That starts with venture capitalists. And eventually that pours down into the retail investor because you know what? These VCs, these private equity firms, they gotta eventually push this stuff somewhere because you know your job as an investor is to invest at the right time, but also know when to get out. All right. It was the late great Kenny Rogers that said you got to know when to hold them, you got to know when to fold them, and that is true when it comes to big industry, big advancements. Okay, it was true in the 20s. It was true in the dot-com bubble. It's true in real estate, and it's going to be true in AI because the one thing that has held forward since before the telephone to after social media is that people remain the same. They go through these phases, if you will, you know, from fear to acceptance to greed, back to fear to acceptance to greed. It's a constant emotional cycle. And once you know when that emotional cycle is, then you can save yourself a lot of emotion yourself. So, you know, let's talk about AI a little bit more. So, you know, I think AI is going to happen at light speed compared to the decades long moves to the upside and the years long moves to the downside that we saw in the last 100 years. So, you know, the $1 million question is, when's this bubble going to pop? So I want to follow the pattern of many steps forward and few steps back. So, you know, in order to get an idea where any bubble is going to pop, you got to start with the starting point is what led to the bubble. So let's go through and let's talk about what I did was I looked at a number of different areas. Okay. I looked at a number of different areas. And the first thing I wanted to do was look at AI. How long has AI been around? So most of us have heard the term AI just in the last year or two. And if you've been in this industry, maybe you've heard it since the 2000s. But you know the term artificial intelligence was actually coined back in the 50s and the 60s. So people like Alan Turing, Marvin Minsky, John McCarthy, these are the pioneers of the term artificial intelligence. You know, computer research is what a lot of people call artificial intelligence. This computer research actually didn't start until the 70s and 80s. And it started with government research. And it started with you know, hello, Watson. Remember that? The 80s to the 2000s. That's when we started to see advancements in data mining. That's it. Let's call it what it is. It was data mining back then too. Neural networks. But there was also a halt during the 80s to the 2000s. And it was where progress in AI, it slowed to a screeching halt. And some of you may remember the term AI winter, which was really caused because of reduced funding. There was a lot of reduced funding to AI. So AI just kind of, you know, when you don't put money at something, then it only grows organically. And there was a very slow growth in AI into the 2000s. You get to the mid 2000s, and now all of a sudden, now broadband's around, and we've had advancements in computer chip technology. All of a sudden, now this stuff can cycle through a lot faster. And we've got all of a sudden, here comes breakthroughs, big data breakthroughs. You got advancements in things like algorithms. You got advancements in, you know, like I said, powerful computers lead to powerful advancements. And so we also see robotics that come in. So what's the pattern here? What's the pattern I've been talking about here for the last 25 minutes? It's simple. It's a pattern that happens in every sector. It's a pattern that happens in every environment. It happens around the world. And it's the 4-part pattern that I talk about all the time, which is the economic cycle or the business cycle. And there are 4 steps to that. There is the expansion phase, okay? Increased economic activity, increased growth. There is the peak, and that's where we hit the highest point of economic activity before downturn happens, okay? Now, typically, signs of a peak include rising inflationary pressures, potential or the start of labor shortages, asset bubbles. Then we have the contraction phase, right? That's where we have that imbalance between jobs and labor and people that can handle those jobs, where all of a sudden the jobs dry up and the labor shortage, or not labor shortage, but the excessive amount of people looking for jobs. So that happens. We have declining demand. We have weakening conditions in the economy. And then we have what's called the trough. That's the lowest point of the economic cycle. What's the last trough we saw in the market? I think you got to really go back to, you could say COVID had a trough, but it was short-lived. But the real trough that I remember happening was 2008 to 2000. So 2012 was really that. 2011, 2012 was when we had the trough in the economy. But if you go back and you look at, again, the question is, when does the bubble burst? My answer is this. Look at the stock market frenzy that happened before the drop. Because you can't just find a bubble you can't find the pop without the expansion of the bubble. So what I did was I went and researched what years did the stock market increase on, were there any years the stock market went up over 50% in 1 year? So stock market typically goes up 10% a year, 12% a year on average. That includes the drops. But were there any years where we saw the averages, the Dow, the S&P, the NASDAQ, increased by a factor of 50% or greater in any one single year? Well, there were a few. 1915. That was during World War I. Dow went up over 81%. Okay? What happened after 1915? That ushered in the 20s. But before the 20s, we went through a period of years where the market just didn't do much at all. 1933, that was the end of the Great Depression. There was a big rebound in the year of 33. Dow went up 66%. A lot of that was short covering. But then the U.S. economy began to recover too. All right, let's move to the 50s. What came in 1954? Dow gained 52%. That was just, we call that post-war expansion. All right, so there's always a reason you can go back and look at. 1975. Remember the 70s? I don't remember the 70s. I was a kid in the 70s. I remember my mother getting a 30-year government treasury bond, and she got it in the high teens, which is unbelievable. And that was 85, 95. It was a 30-year bond. And if you bought a 30-year bond back in the 70s, back in the mid-70s, you had the mid-80s, the mid-90s, and you got to 2005 before that thing matured, making you 19, 20% a year. Unbelievable. Well, in 1975, you had the Dow, that rebound in the Dow. Now, I'm going to move into the 90s because now we bring in the S&P. All right? S&P. S&P had about a 34% move in the 90s, but it didn't have a 50% gain. But get this. Here we go. 1999. This was the peak of the dot-com bubble. The NASDAQ, get this, gained 86% in 1999. So what are we looking for, folks? We're looking for these some of these gains were off bottoms. The big gains, however, were near the tops. And during the dot-com bubble, NASDAQ jumped over 85% that year. So I want you to keep this in mind. The last one was, NASDAQ gained almost 50% off of COVID, but that was a bounce too. But when you look at expansion years and you look at peak years, typically the stock market gains the most during those advancements before the bubble hits. Now, think about AI. What are the top AI players in the industry right now? There's NVIDIA and their GPUs, okay? Graphics processors. That's what NVIDIA is most known for. And that's why their company is going up like crazy, because people need their processors. How about Google? Alphabet. Alphabet. They're investing heavy into AI research and development. Okay? I mean, they got projects out there. Have you heard of this Google Brain? They got Google Brain versus DeepMind. So they're going to have their own version. You know, ChatGPT is just the beginning, folks. You've got Google Search, you've got Google Assistant, you've got Google Cloud right now, you got Google Brain coming, you got DeepMind coming. Google is, Alphabet is knees deep into AI. Number 3, Microsoft. Now, you know, it is said right now, and I don't know this to be fact, but there's a lot of people saying this, that if you haven't checked out Bing yet, B-I-N-G, a lot of folks, and this is the younger folks talking, are saying that Bing is a better search engine than Safari, than Google Chrome, right? That Bing is on top of it. Don't take my word for it. Try it out. But, you know, Microsoft's got that. They've got their Azure cloud. So that's coming too. And they're working on AI solutions for machine learning, computer vision, etc. All right. Number 4, bet you didn't know this, Amazon. So most people, when they think of Amazon, they're watching out the front door for the van to pull up and throw packages down, and maybe watching to make sure porch pirates don't take them away. But Amazon does so much more than e-commerce. They have AWS, that's their Amazon Web Services. They've got an entire cloud computing division. All right? And yeah, they're in the same thing too. They're in machine language learning. They're into processing. They're into computer vision. They're looking at it on the B2B side and on the development side. So when you think of Amazon, don't think of Amazon as a place to get all your packages and all your needs without leaving the house. You got to think of Amazon as a big player in AI now too. And then finally, and this is the company that I think started it all, is IBM. IBM, you know, remember Watson? Can you hear me? That was Alexander Graham Bell with the first telephone conversation that was, you know, heard. But IBM had Watson, which was the chess beater, but also one of the very first, most powerful computer of its time. So what's IBM doing now? Well, they've got the Watson platform, which is their AI solution, their analytics, and their industry-specific applications. So IBM, which I think was the real pioneer in this, they just, you know what happened? They were the pioneer, then they flatlined for the longest time, and now they're coming back. But there's your top 5, folks. All right? Let me say them again. NVIDIA, Alphabet, Microsoft, Amazon, IBM. I'm looking for big things in AI. I'm looking for the continued frenzy, not just on mainstream media, but local media as well. Are we there yet? I don't think so. I think we're at the beginning of the peak. So guess what that means? That means we continue to ride this bull. And you know what's going to be tailwinds for this? I believe what's going to be tailwinds, you've got the rest of this year, 2024. Okay, it's an election year. The last thing the government wants to do is cause any problems, because the folks that are in office want to be reelected. So you got that. Number two, interest rates are still sitting around 5.25%. While I don't believe they're going higher, which is good, I believe they're going to stay flat. Maybe we get a rate cut this year. Staying flat or getting a rate cut is going to be good for companies like tech companies and AI, because people are going to want to put their money where strength is. And that's where the strength is right now. Take a look at these charts. Look at charts of Amazon, all-time high. Look at charts of Google getting there. Look at charts of NVIDIA, almost back to all-time highs. IBM, etc. Amazon, Microsoft. I mean, these guys are swinging. These are the big swinging stocks right now for the NASDAQ, for the S&P 500, even some for the Dow. But when is the end going to happen? I don't think we're going to see it this year. What I do think is going to happen is we still have to see everybody talking about this. So until then, I think we continue to ride the bull. But let's keep an eye on the greed. Let's keep an eye on when your neighbor, who knows nothing about the stock market, starts talking about AI. When that happens, when you start hearing this out of people you shouldn't be hearing this out of, when you start seeing the new crop of YouTubers that come out of nowhere that used to be in construction, or maybe they were one of the characters in Disney and all of a sudden now they're AI experts on YouTube. When these folks start getting subscribers, that's when you and I want to financially swipe left and call it a day. All right. Thanks for joining me. I hope you hung out with me this long. I tend to chatter a lot on this one. Hey, take a look at me next week. I'll be back. I'm going to be jumping into a look at the market, and I want to talk about cheap options. For those of you that are option traders, you're going to want to check that out. What options out there are the cheapest? And I'm not talking about cheapest on price. I value options a bit differently than someone who just can tell you, oh, these are the cheapest options out there because they're a nickel, they're a dime. It's not the way I look at it, folks. I'll explain exactly how I look at them, and I'll give you my top 10 cheapest options as we head into mid-May. Have a great weekend. We'll see you soon. Bye now.